You are working hard for your money, but every day your money sits in the bank is another day that it loses value. So how do you put your money to work for you? That is the basic goal of investing, to make your money work for you and grow over time.
But won't my money grow if I keep it in the bank?
No.
You can blame the inflation rate and low interest rates for that. The inflation rate is defined as how much value or purchasing power your money loses over time. So the inflation rate in the USA last year was 1.4%. Now, if you were lucky, the savings rate that you would get if your money was in a bank account in the US was 1% at a stretch. That means that keeping all your money in a bank account is akin to the rats eating Pablo Escobar's buried money. So how do you start investing? My name's Cairo. This is my $1 Million Hustle Challenge, trying to get my net worth to over $1 million in the next 3 years. And to do that, I need to make sure that I make my money grow for me. There are many ways to start investing your money, ranging from real estate to bonds to investing in businesses. But for the purposes of this video, we'll focus on the most common way of investing, and that is investing in stocks. Now, if you want to learn more about investing in real estate, make sure you check out this video that I've linked in the cards and in the description after you finish watching this one. What is a stock? One way that companies raise money is by issuing shares or stocks. In simple terms, a stock is one small piece of the pie of the company's overall value. So how do you make money from buying stocks? You can make money in one of two ways. One, selling your shares once the price per share goes up. This is known as value investing. Or two, this is when companies pay out a percentage of their profits in the form of dividends to shareholders. This is known as dividend investing. Not all companies pay out dividends though, so that's something to keep in mind when investing in stocks, and it will form part of your investing strategy. Public service announcement. Investing does have risk associated with it. The value of your investment could go up, could go to the moon, or it could come crashing back down to earth. That's why it is generally considered best practice to invest for the longer term, at least 5 years. And there are several ways you can reduce your risk, with the main one being
diversification.
This is just another way of saying don't put all your eggs in one basket. For example, putting all your money in a single company like Apple is great if the price of Apple goes up, if Apple is doing well as a company. But what if Apple gets a little moldy? You could lose everything. So it would be much safer to spread your investments out amongst several different companies, right? That means if one company bombs, at least the other companies still stand a fighting chance of doing well and giving you a return on your investment. This goes beyond investing in just stocks, as it also applies to investing in other asset classes. By asset classes, I mean bonds, I mean gold, I mean commodities, real estate, cash, as well as more alternative investments like cryptocurrencies, art, or even Pokemon cards. Hey, if you've made it this far, please hit that little thumbs up button, crush the like button. It will really help me get this video out to more people, because financial education is not something they teach in school. How do you actually buy shares though? Well, first you need to pick a brokerage. And there are loads of options available like Schwab, TDAmeritrade, M1 Finance, Webull. Those are all in the US. If you're in the UK, there's Trading 212, Stake, who are also in Australia and New Zealand, Freetrade, Hargeaves, Lansdown, that's just to name a few. Webull is a great commission-free broker. This means they don't charge you when you buy and sell stocks, which a bunch of other brokerages do, so that is something that you should keep in mind when picking a brokerage. And if you click the link down below for Webull, you can get 2 free stocks when you fund your account over there. I'll also put links down to some other brokerage options. It might even be a good idea to have more than one broker account. So once you've chosen your brokerage accounts, it is time to put some money in and invest. But what should you invest in? You can buy individual stocks in companies like Tesla. And don't worry, you don't need to buy an entire share in Tesla, which at the time of making this video is over $870 a share, because more and more brokerages are allowing you to buy a fraction of a share. That means you could still invest in Tesla even if you only had, say, $100 to invest. Some online brokers allow you to buy bonds as well. Now, bonds are usually a safer investment, but because there's less risk, there is also less reward and lower returns. Now, a bond is generally a loan that is issued by a government or a company, and then they pay out interest rates on that loan. Two more options to consider are mutual funds and exchange traded funds. These are also known as ETFs. So what is a mutual fund? It is a collection of money from a whole bunch of different investors that is then pooled together and used to buy stocks and bonds. Mutual funds are usually actively managed. That means there is a fund manager who is making the decisions as to where to invest that fund's money.
And for these expertise, the fund managers charge high fees.
Now, an exchange traded fund or ETF is similar to a mutual fund in that it can consist of different stocks and bonds. But the main difference with an ETF is that it is traded on a stock exchange, much like a stock is. And ETFs are usually passively managed. That means the fees to buy ETFs are significantly lower than mutual funds. So, starting off with investing, it is much more advisable to focus on ETFs than mutual funds. That's because the fees that the mutual funds charge you eat into your compounding growth over time. How much should you invest though? Well, when starting out, let's walk before we run, okay? I'd suggest buying an index fund or an ETF that tracks the S&P 500. These are the 500 biggest companies in the US, including companies like Microsoft, like Amazon, like Apple, like Tesla, like Google. And this is a great, inexpensive way to diversify your portfolio without having to individually buy stocks. It also means that if a company falls out of the top 500, that another company replaces it, so that you are continuously investing in essentially the overall US market. So some examples of ETFs that track the S&P. One of them is Vanguard's one, and that has the ticker symbol VOO. And another good one is the iShares Core one, which has the symbol IVV. So you might want to start off with putting in $100 to $200 every single month until you get more comfortable with investing or until you have more money to invest. Now, when was the best time to start investing? Well, that would have been decades ago, but the second best time to start investing is now. The sooner you start investing, the sooner you can start taking advantage of that sweet compounding effect of having your money work for you. I'll be going into way more detail about the rest of the stock market, other side hustles, and more ways to make money. So make sure you crush the like button and subscribe to join me on this $1 million hustle. Don't forget to grab your free stocks by clicking the links down below. Watch these videos next, and I will see you in there. Let's hustle together.